Hello, everybody, and a happy Friday to you. From me, Jason Greenwood, it is the 23rd of July, 2021. It is awesome to be here with you again for another episode of At the Coalface Live, which I do every single Friday at 4 p.m. New Zealand time, 2 p.m. Australian time, and whatever your local time is. Awesome to be here with you again. As per usual, it has been a crazy week in the e-com space. It's been very busy. I've personally been very busy. My business has been very busy. Just had a new RFP on behalf of a client go out to market for a new build and development of an e-com solution for the business, which is super exciting. I've got some new inquiries this week, actually mainly from LinkedIn. So look, anybody that tells you that effort on social media doesn't work around your niche in terms of building expertise and putting that expertise into the market and proving that expertise via social media and then having that generate inbound queries to you and for your business and for your service that you offer. They just don't have the patience, obviously, for that, because it does take time. It takes time to continue to put your thoughts out there, open them up for critique, open them up to be, challenged and all those sorts of things. So again, super stoked to be with you here today. As per usual, the format will be, I'll go through all the latest news today and all the things that I want to cover off. And at the end, I'll come back to all the live commentary, any questions, comments, etc., etc. I'll come to those at the end so it doesn't sort of break the flow of the news. So look forward to seeing all your comments, all your thoughts, all your questions in the live comments stream. And then at the end, I'll sort of take 5-10 minutes at the end and come back to those. So really looking forward to interacting with you guys today. Now, before I kick today's session off, I just want to take a moment to speak about the frothiness of the capital markets right now, and that frothiness, how it's actually impacting the e-commerce space. Because at the moment, there is so much capital sloshing around in the system, and it's cheap capital that's flooded the system via the central banks globally, who are trying to keep economies afloat through the COVID pandemic, and really, more importantly, to the handbrake that they're putting on their own economies by locking their economies down. So what they're doing is they're hobbling their economies on one hand by locking them down, and on the other hand, they're pumping in cheap liquidity to try and keep them afloat. Now, what that's causing is it's causing what's called distorted or artificial capital flows. Now, because the loans that the central bank is giving out via the local banking system are at very low interest rates, what that means is that invested capital into banks is also at a very low interest rate. So basically, investors are taking all this cheap capital that they have access to, and they're looking for yield. They're looking for a return on their investment. And so what is the one area of our global economy that has absolutely boomed over the last 18 months? Well, it's e-commerce, of course. As people are locked down and as they've been forced to stay home, as they've been forced to shop online, tons and tons of that traditional bricks and mortar revenue, which historically, as a percentage of global retail revenue, e-commerce, depending on the country, made up anywhere from about 9% up to about a maximum of about 30% of total retail was e-commerce retail revenue. So we had, even in a best case scenario like China and the UK, we still had over 70% of retail revenues coming through bricks and mortar sales. But obviously, this got turned on its head during COVID, and overnight we had lots of businesses who overnight, literally 100% of their revenue now had to come through their e-commerce channels, because that's the only way that customers could buy through them. Now, what that has had, the upshot of that, or the outcome of that, the inevitable outcome of that, is that as VCs, as venture capitalists, as private equity, as banks, as funds are going out there and they're looking for return on investment, what that has meant is that we have these radical capital flows going into anything related, even tangentially, to e-commerce. Now, it's almost like venture capitalists just basically throwing a bunch of money at the e-commerce wall and seeing what sticks, because they know that, if 1 out of 10 investments can boom, then it can make up for the losses on 9 other investments. That's about the track record that most VCs shoot for, scores, about a 10% success rate on their investments. And they know that that one success will usually not only make up for the 9 losses, but it will, it could potentially turn into a unicorn worth billions. So that's kind of the operating model of most VCs. Now, that's creating distorted capital flows, as I mentioned. And what that means is that right now, every platform, technology, e-commerce focused retailer, pretty much if you are in the market for funding right about now would be the time to go out and try to get it, because VCs are looking for places for their money. And that's largely the news that I'm going to be talking about today, is what those distortions have done to the market and the blinders that it's put onto the market. And I'll call out some of what I think is perhaps questionable investments into questionable areas, where I'm looking at this as an e-commerce specialist who's worked in it for 20 years and gone, I'm scratching my head. This doesn't make sense to me. And if something related to e-commerce just doesn't make sense to me, that raises red flags for me, because normally if something is a good investment, it stands out to me in the area of e-commerce, because I can connect the dots very quickly about whether they're a platform provider, whether a services provider, whether they're a retailer. Depending on what area they specialize in, I can very quickly connect the dots, and therefore I can kind of understand what kind of valuation they should be at when investors look to invest in them. However, at the moment, all the rules of the game are out the window, because we've got these distorted capital flows, and I'll speak to that throughout this episode today. And one of the key things that you'll see called out here is that pretty much every VC discussion happening right now around e-commerce based businesses or platforms or technology is about revenue. It has nothing to do with profitability. 9 times out of 10, the articles that you see released on TechCrunch and all the other, e-commerce and investment news websites, what you won't see is the profitability of the companies that are being invested in. Almost never will you see them talking about their margins, their retained margins. You'll hear them talk about, their ARR. You'll hear them talk about annualized run rate or annualized revenue. You'll hear them talk about lots of metrics, lots of quasi-financial metrics. But what is oftentimes not discussed is profitability, because lots of times these companies are simply not profitable. They are chasing revenue in the hopes of building a moat around their business so that in the future they can become profitable. Now, we know that sometimes that does happen. If you look at Amazon, obviously they were not profitable for many, 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 many years. And the poor, long-suffering investors had faith in Bezos that he could turn the ship around, and that almost at will, he could turn the company around and make it profitable once he stopped reinvesting so much capital back into the business. Now, as we all know, that's actually what's happened. So he built this massive moat around his company. He built massive profitability in the e-commerce side of the business, the AWS side of the business, and in other branches of the business. And then all of a sudden now he's got pricing power in the marketplace. He's got almost monopoly power in the marketplace. And now he can start ratcheting up the profitability on Prime and various other things. So he's got lots of levers he can pull to bring profitability into the business that doesn't rely on shareholder investment to keep the business afloat like it did at the beginning of Amazon. However, Amazon is a flipping unicorn. So the reality is that most businesses aren't going to become an Amazon. Most of these businesses are going to go out of business, especially because they don't have to have necessarily, if they're flush with capital that's being invested into their business, then sometimes what happens in that scenario is financial rigor goes out the door, because they've got more money than sense. And as a result of that, they don't have to have that financial rigor that is focused on profitability, because they've got enough runway with investor funds that they can just basically, it's almost like monopoly money in some respects. So I'm going to speak to that a little bit today. But one of the news stories that just was eye-watering this week that came out was VTech, which is an e-commerce platform, and I'll speak to their listing on the New York Stock Exchange and what that means for them and for the industry at large. But in one of the articles that was talking about VTech's listing this week, it said that their listing was just one of 27 IPOs on the New York Stock Exchange this week that were seeking to raise more than $6.6 billion worth of capital in one of the busiest weeks of the year on U.S. exchanges. And that was a report by Bloomberg. So pretty amazing week in the tech, e-com, digital space. And I'll get into some of those announcements this week. So One of the big announcements this week was that headless e-com platform Fabric raised $100 million in a Series B round of funding to expand their business. Now, what's interesting about this is I've never heard of Fabric before. They are certainly not a well-known e-commerce platform. They're certainly not a well-known headless e-commerce platform. So, it's pretty interesting that a business that is certainly not that globally known for even people that work in the space, that they're able to pretty easily go out there and raise an additional $100 million from the market to grow their platform, to grow their marketing, grow their technology, and go out there and take it to the market. Now, what's also interesting about this is that this round of funding came only 161 days after completing their Series A round of funding. And to date, they have raised $153 million. They grew revenue 800% year over year. And they say that they're obviously trying to capitalize on the growth of e-commerce, which, obviously everybody that says they're in e-commerce says they're trying to capitalize on COVID-fueled growth, which makes sense. But one of the notes from this press release that did have me a little bit concerned is their target market or their goal. And that's that they said, we are going up against Shopify to compete in the multi-trillion-dollar e-commerce market. Now, if their goal is to take out Shopify, that's going to be an interesting challenge because many other e-commerce platforms have tried and failed. Shopify is still the largest and the most adopted dedicated e-commerce platform in the world. I'm discounting and leaving out other content platforms that have bolt-ons and plugins, like WooCommerce is a plugin for e-commerce into other platforms. But if we're talking pure e-commerce platforms here, Shopify is by far the biggest. They've got nearly 2 million merchants on the platform. They're the 800-pound gorilla in the space. And in their latest Unite announcement, Shopify has started to talk about nitrogen and oxygen and them going to and developing a headless front end to go with their e-commerce backend. So I think, newer platforms like Fabric are going to start to struggle if their primary target competitor is Shopify, because Shopify has such a big head start against them. But it's going to be interesting because Fabric talks specifically about B2B functionality, which Shopify doesn't have. And so if they're trying to target the B2B and the B2C space equally, I think they potentially have an opportunity there. API-driven platform, like all headless platforms say they are. So it's going to be very, very interesting. Now, one of the data points that they brought out as part of this announcement, which I thought was an important one to bring out and to raise, was that global e-commerce is expected to surpass $5 trillion globally this year. And B2B e-commerce specifically is expected to reach $20.9 trillion by 2027. Now, obviously, that's a big deal for me personally because in Greenwood Consulting, I focus on B2B and D2C brands for e-commerce. And so, to see those kind of growth estimates for B2B e-commerce is really reassuring that it backs up what I'm seeing in the market, which is B2B brands increasingly wanting to enable e-commerce capabilities in their business, unlike ever before, as they move away from an in-person physical sales model. Now, next big piece of news in the markets is VTech. As I mentioned, they debuted on the New York Stock Exchange with a market cap of 4.5 billion USD. Now, VTech is a popular SaaS e-commerce and order inventory and marketplace management platform, founded in Brazil in 2000. So they're a 21-year-old platform. VTech acquired Work Area Cloud Commerce in February of 2021 to go into the United States market specifically. They count and list on their website some of their customers, including Walmart, Levi's, Sony, L'Oreal, Motorola. And they previously raised $140 million in November of 2019 and then raised $225 million at a $1.7 billion valuation in October of 2020 before going public this week. So we knew that this was happening. They submitted their US F1 filing request to go public on 25th of June. And from their key stats, now what is really interesting about this is if we look at their revenue numbers versus their valuation, it just boggles the mind. So they had 99 million, so not quite $100 million in revenue in 2020. Doesn't say anything about their profitability again, but that was a revenue growth of 61% year over year. They said that they've got over 2,000 customers, with their top 10 customers accounting for nearly 20% of all revenues. And the IPO did far better than even VTechs and their fund managers expected and underwriting bankers expected them to do. So shares opened at $25.10 USD after being priced at $19 by the underwriters Tuesday, and well above the expected market range of $15 to $17. Just blew the valuation out of the water. It raised $361 million for VTechs to grow their platform and grow their marketing into new markets. And grow their technology capabilities across the whole of the platform. And, as I said, an over $4.5 billion valuation, just insane numbers, just absolutely insane numbers. So, congratulations to VTechs, huge money, huge IPO. And it just goes to show how important e-commerce is becoming and e-commerce technology is becoming as part of our overall market dynamics and trading dynamics on the major exchanges globally. Now, in the bucket of eye-watering ease of raising money, there's another scale-up based out of the UK. They're called the Moot Group, and they just announced yesterday, I think it was, that they just raised £5 million in seed funding. So that's pre-Series A, pre-Series B. This is basically the first round of funding that most businesses get when they go out to the capital markets and the VC markets. So this is the seed round. Sometimes there's a pre-seed round of maybe private friends and family investors or inside investors. There's sometimes a pre-seed round, but usually the seed round is the first major round of funding. They just got £5 million. What's interesting about this, they're on track to reach £100 million in revenue in 2022, growing at 1,300% per annum, which is obviously massive growth rates. They're looking to hire an additional 30 people. But what's interesting about this funding is that they've already telegraphed to the market that they are going to go back to market very shortly with their Series A round and expect to raise an additional £20 million. So that would make a grand total of funding of £25 million, which is not a small sum by any stretch of the imagination. Now, what's further interesting about this announcement is that I went to their website and I read first of all, I read the press release, and then I looked at their website, and I'm really quite confused about what the value prop is of this platform / technology / brand and marketing company. As near as I can tell, TMG is actually a holding company. They've got some of their own retail brands. They bought a couple of retail brands out of bankruptcy, resuscitated them as pure play e-commerce brands, and they built their own e-commerce platform for their own retail brands. So they focus on homewares and home goods, which obviously boomed during COVID. And so they've built their own e-commerce platform. They also have their own warehousing, their own logistics technology, according to them. So their own sort of 3PL, 4PL type services. Plus they offer digital marketing services as well underneath their TMG umbrella. So what it feels like they're trying to be is both a brand owner, but also a little bit like Amazon, in that they commercialize their own technology and then sell that out to the market too. So in other words, to other merchants. So they're saying, hey, we've spent however much it cost us to build our own e-commerce platform, our bespoke platform in-house. Now we're gonna what actually, if I was reading between the lines, I would think that they're trying to actually defray the huge development costs that are involved in building a bespoke e-commerce platform by effectively selling it to any other brands that want to use that platform on a licensed basis. So they're probably finding that the cost of continuing to build a bespoke platform itself is quite high, and that by commercializing this and productizing this platform, it can help them offset some of those extreme costs of building their own platform out. So they said that Sports Direct, which is a huge retailer in the UK, they said Bet365, White Company, a couple of other big retailers are customers of their platform already. What's interesting is when I visited sportsdirect.com and I looked at their built with profile, kind of almost like a big red warning came up, and it said, "This is misleading technology profile warning. Sportsdirect.com is on our misleading profile site list. This means that various pages across sportsdirect.com and its subdomains make it difficult for us to accurately tell you what this site is built with." So clearly they are doing something in the headers of their website to obfuscate what their platform is. They call their platform Bolt. And so Bolt is a technology and a services layer on top of that, including logistics and including digital marketing. So it's just quite interesting that they've been able to quite easily raise £5 million. They think they're going to very easily raise another £20 million. And as we know, in the e-commerce services business, margins are extremely low versus a physical product retail business as a rule. So I hope that the investors in this business understand what they're getting themselves in for, understand the risk profile. And one of the comments by the CEO, Nick Moot, who also founded the company, he said, when I first started Olivia's in 2019, there was no streamlined technology stack that gave me all of the tools I needed in one platform for one cost and provided a great customer experience. Well, I can personally call bullshit on that because 2019 was only 2 years ago now. And there was Shopify, there was BigCommerce, there was lots of other e-commerce. There was Magento, there was lots of other e-commerce platforms in the market, and some of them, like VTech, for example, do have an end-to-end platform with inventory management, with order management, with marketplace platform support built in. So I call bullshit on that statement because there are other platforms out there that do offer what he's saying are not offered in the marketplace. Now, if he'd said in 2010, then maybe I could have agreed with him. But if he was looking around in 2019 and couldn't find an off-the-shelf platform to meet his requirements, then I suggest he probably wasn't looking that hard. So yeah, interesting to see what's going to happen with that particular investment. Now, another big investment that just got announced by TechCrunch was the instant grocery startup GoPuff. It just raised $1 billion on a $15 billion USD post-money valuation. So they're an instant grocery delivery startup, almost like the Uber of grocery. There's a few of these. There's Ocado, and there's a couple of other competitors in this space. Very capital-intensive business model. Obviously, have to have both the tech, have to have certain infrastructure for logistics, and it's just a very capital-intensive business model, which is why they need so much money. And what they said is that they're trying to raise $1 billion in this round. But also what they called out is that this company has raised an absolute boatload of cash historically already. So in March, they raised $1.15 billion at an $8.9 billion valuation. That round itself came months after a $380 million capital raise at a $3.8 billion valuation. So at least they haven't had a down round. In other words, their latest valuation is higher than their last valuation. So they haven't had a down round, which is good in a way, because it means that their ability to go back to the market in future will be made easier because they're showing up rounds and an upwards trajectory of valuation over time. And so they've raised $2.5 billion in 10 months. That is just a staggering amount of money. So basically, they are seeing similar sorts of challenges around capital raising that we saw in the transportation on-demand market, the Ubers, the Lyfts of the market, and how capital intensive those markets are to gain market share and build a moat in your local markets. Now, another big piece of news actually comes to us out of Australia, and this is from the ACCC, which is the Australian Competition and Consumer Commission, and they have announced that they are they've actually had an investigation into the largest Australian e-commerce marketplaces running for the last 5 years. So the companies under this investigation are Amazon, Catch, eBay, and Kogan, which all run e-commerce marketplaces of their own. And it says the ACCC continues its 5-year investigation into digital platforms operating in Australia, consumers, platforms, and third-party sellers. They're soliciting feedback from small businesses to major brands to make submissions to the ACCC as it studies a range of potential issues potentially impacting on open market competition. So I've said many times before, I think Australia is rapidly approaching a scenario where they are over market placed. And when I say over market placed, I mean that they have probably, I don't know what the exact statistic is, but I would suggest they have more marketplaces, e-commerce marketplaces per capita than any other country in the world. And I don't believe that ultimately in the long term is sustainable. They've got well over 10 major marketplaces operating across B2C and B2B today. There has to reach an equilibrium between supply and demand at some point. Are there shady business practices? Are there anti-competitive business practices going on at Amazon, Catch, eBay, and Kogan? Well, I have no idea. But, we know that Amazon has been wrapped across the knuckles in the United States and in Europe for anti-competitive behavior in the past. I don't think Catch has. I don't think Kogan ever has. And I'm not sure about eBay. Possibly at some point in their lifespan they have, because they've been around for so long. But we certainly know Amazon has. So is this a case of, unfortunately, Catch, eBay, and Kogan being caught in the same net as Amazon, and they're not guilty of anything at all? Certainly that is a possibility. But if I was in the marketplace space in Australia, I certainly would not want the ACCC crawling all up in my grill and into my financials and into my competitive practices and speaking to my customers and my competitors to get a feel for my behavior in the market. Because obviously, if you're a competitor to these guys, you're going to try to find some way of making them look as bad as possible so that they perhaps get reined in with some sort of antitrust ruling or sort of forced breakup or something like that. So it'll be very, very interesting to see how this plays out. I'm not a fan of heavy-handed regulation around tech companies. I think so long as the market is, a somewhat even playing field and the environment is conducive for businesses to be able to be start and grown and run in the country, then I think the free market has to decide who's the winners and the losers. And I just don't strongly believe in a government that picks the winners and losers in any industry, particularly e-commerce. And I think the market's going to sort itself out. I think that it is unsustainable. The number of marketplaces, the amount of catalog overlap between these marketplaces is huge. I mean, how many marketplaces does Australia need? Does it need 20? Does it need 50? Does it need 1,000? Does it need 5? I don't think we know the answer to that yet, but I think we're going to find out, because it seems like a new marketplace launches in Australia every single week. So we are going to find out soon, and we're going to find out what the ACCC thinks about the subject as well. Now, in some other final news and announcements, my new podcast dropped this Thursday, my latest podcast episode with Fiona Norton from BigCommerce. We talk B2B e-commerce specifically, and about BigCommerce's new B2B edition and how it helps B2B merchants to serve their customers better in an e-commerce capacity and in a hybrid commerce capacity. So it was really interesting to hear some of her stats coming out of their experience as BigCommerce and what they're seeing in the marketplace, what caused them to want to build out this new edition of their platform, what gaps they're trying to fill, and how they feel that they are better placed than just about anybody else to help the B2B e-commerce market grow and thrive. So do check that out. Also check out the Coalface Digest. I'm currently running a prize draw. If you look at my LinkedIn posts for the last couple of days, I'm running a prize draw for free 10 free subscriptions to the Coalface Digest. All you got to do is find that post, like and comment on the post, comment "I'm in" the post. Winners will be announced next Tuesday. So check that out on LinkedIn. I will be speaking at Retail Global New Zealand in Queenstown, August 17th through the 19th at the Queenstown Hotel. Now, obviously, with these latest lockdowns happening in Australia, in Victoria and New South Wales, it's looking very much likely that, unfortunately, the Retail Global team from Australia, which is where this event is actually being organized from, which is from their Australian offices and their Australian team, it's looking more likely that their Australian team will not be able to come across for the event, which is really, really sad to hear. So stay tuned for any further announcements. Yours truly may be tapped to do a few more duties at the event, maybe speak on a few more tracks. Fingers crossed, I might even be able to MC the event. I'm working hard to try to offer up my services for that. So I will definitely be there. I've already got 2 tracks I'm speaking in, and I wish those guys well. It's a real shame, because I was hoping I was going to be able to catch up with the Retail Global team in Queenstown, but it's looking increasingly like they will not be able to come along and attend the event. So I know it's getting close to being sold out. I know it's been very popular. It's one of the only e-commerce focused events, in-person events this year in New Zealand. So I suspect it is going to be an absolute cracker. So get your tickets before they sell out. I spoke at ITX Innovation Days today about e-commerce. and about omnichannel commerce specifically. I think I was the only speaker New Zealand-wide of all their innovation days that focused on e-commerce. All the rest was about IT, security, and other IT-related topics. So it was really cool to be there and represent the e-commerce industry at ITX Innovation Days in Auckland today at Ellerslie Racecourse. And always enjoy speaking out publicly about e-commerce and representing our industry and helping to grow it any way that I possibly can. I'm a big believer in a rising tide floats all boats. So the more that I can do to help the industry grow, it benefits everybody that's even tangentially related to the e-commerce space. So always enjoy doing that, and always enjoy just, I guess, speaking on behalf of our industry wherever I can. I'll go back now. That's the end of the news conversation. So I'll just go back to the thread here, and I'll just look at everybody's comments. Hey, Alex, great to see you, man. Ash, great to see you. Thanks for your support. Really appreciate it. RevK, B2B commerce on fire. Absolutely, totally agree. I think B2B commerce is just it's an unsung hero. It's an unsung opportunity in the e-commerce space. It is very complex. It's much more complex than B2C e-commerce and even D2C e-commerce. But I think the growth story in e-commerce over the next 5 years is going to be one in the B2B space. I think it's super exciting. Can't wait to help more brands do B2B e-commerce either for the first time or significantly level up their B2B e-commerce game. I think there's just tremendous opportunity here, fueled by COVID, and I'm looking forward to playing a big part in that over the coming years. And John, thank you very much for your support. Really appreciate it. Awesome concept to have the rated #1 products on its own platform so that you could leverage it yourself. So yeah, absolutely, totally agree. So thank you very much for watching today. Really appreciate it. I will be here next Friday, as always, 4 p.m. New Zealand time for the live show. And if you want to connect with me on LinkedIn, if you're not already, feel free to pop through any sort of questions throughout the week via direct message. Just flick me a message if you want me to discuss a topic on at the Coalface Live on the following Friday. Feel free to fire anything through, fire any questions, fire any comments through that you want, and I'll make sure and raise those. Even if you can't attend live and watch live, I will make sure and raise those at the next live event. So thanks again. Have a fantastic week, everyone. I'm going to be, so I'll say a big fat cheers. That's a tasty bourbon. So have a fantastic weekend, everybody, and I will see you on LinkedIn in the comments, and I'll also see you live next Friday. Cheers, guys. Catch ya.